For many businesses, accounts receivable, AR, are more than just a line item on the balance sheet. This account provides a key indicator of potential cash flow, customer relationships, and overall financial health. So proactive AR management is critical. The AR aging report has long been a cornerstone of expediting collections and reducing credit risk, but it's taken on greater significance with the implementation of new accounting rules for recognizing credit losses. Digging deeper into receivables, the AR aging report provides a structured breakdown of all outstanding customer invoices. Rather than simply listing balances owed, it categorizes AR based on how long each invoice has remained unpaid. The following time-based aging buckets are typically used: 0 to 30 days, current, 31 to 60 days, C1 to 90 days, and over 90 days. This breakdown helps management evaluate trends in customer payment behavior, identify chronic late payers, and assess how credit policies are performing. The information can be used to prioritize collection efforts and determine when receivables should be written off. Management also might use it to modify overall credit practices, for instance, offering early bird discounts or electronic payment methods to encourage faster payments, or tighten credit policies for certain slow-paying accounts. Optimizing cash flows. By revealing how long invoices have been unpaid and identifying customer payment trends, the AR aging report helps businesses forecast future cash receipts. This can help management more accurately budget operating expenses, determine the need for short-term borrowing or credit lines, and plan investments or capital expenditures. For instance, if a business sees that 40% of its receivables are older than 60 days, management can anticipate cash shortages in the next cycle and act preemptively. They may decide to delay certain discretionary expenditures or reevaluate vendor payment terms to maintain liquidity. Using aging buckets to estimate write-offs, starting in 2023, private entities that follow U.S. Generally Accepted Accounting Principles, GAAP, are required to implement new accounting rules for reporting credit losses on financial assets, including trade receivables. The rules went into effect for most public companies in 2021. The updated guidance requires companies to estimate an allowance for credit losses based on current expected credit losses, CECL, at each reporting date. The net amount reported on the balance sheet equals the amount expected to be collected. The CECL model essentially requires companies to estimate write-offs sooner than in the past. Under prior accounting rules, a credit loss wasn't recognized until it was probable the loss had been incurred, regardless of whether an expectation of credit loss existed beforehand. Under the CECL model, a loss allowance must be estimated based on historical information, current conditions, and reasonable and supportable forecasts. This estimate is often derived using historical default rates from aging buckets and adjusted for current and forecasted economic conditions. AR aging reports provide the historical and current data necessary to project the probability of default for various customer segments and invoice age groups. Estimated credit losses are recorded on the income statement as bad debt expense, directly reducing net income. Financial statement footnotes may also include detailed aging data and descriptions of how the loss estimate was developed, particularly if receivables represent a significant portion of the company's assets. It's important to note that the Financial Accounting Standards Board is currently working on proposed guidance that, if approved, would allow private entities to use simpler assumptions to estimate credit losses on short-term receivables. However, regardless of whether the proposed simplification measures are approved, the AR aging report remains an essential tool. It helps quantify expected losses with or without complex forecasting. A strategic management tool. QuickBooks and many other accounting software platforms can generate real-time, customizable AR aging reports that integrate with customer relationship management systems for seamless tracking and follow-up. If you're unsure whether your current processes are CECL compliant or you need assistance leveraging aging data to strengthen collections, credit policies, and budgeting decisions, we're here to help. Contact us to maximize the potential of your receivables data.